Here's how to use daily economic indicator reports in your trading because they have a dramatic impact on futures prices. Now, the release of economic reports, which is pre-scheduled, or those economic indicators, is a tool that experienced investors use to enter or even close out trades in the financial markets. There are a few important economic indicators that we follow all the time. The most important is the GDP. That's the gross domestic product of an economy. It provides the overall value of the goods and services that an economy produces, and it indicates whether the economy is going up, going down, heating up, slowing down, okay? The gross domestic product is the most widely used indicator of the growth in the economy. It combines the monetary value of every good and service produced over a certain period. And it considers household consumption, government purchases, imports, exports, and in the U.S., it is released quarterly and yearly, okay? There are initial and final reports as well, but you are going to see those published, and the market is going to turn on the release of those numbers. When I say the market's going to turn, I mean the indexes are going to go up or down. The Dow, the NASDAQ, the S&P. This is why we follow them. Next, unemployment and employment figures. The Department of Labor puts out a monthly release of employment numbers that include the number of jobs that are created the previous month by the private sector and the government, as well as the national unemployment rate, okay? Also known as non-farm payrolls. It is released on the first Friday of every month, okay? Traders wait for that release, okay? It comes from the U.S. Bureau of Labor, and it is one of the most closely watched reports, okay? Here's how we track that. The high unemployment rate or a low unemployment rate are going to be seen as positive indicators for the stock market. Let me say that again. A high employment rate or a low unemployment rate is a positive indicator, because when employment is high, consumer spending is likely to be strong, and that can lead to higher profits, a stronger stock market, indexes going up, okay? That's how you want to trade, knowing what is going to influence that in advance. These reports come out at a pre-scheduled time. I'm going to show you that in a second. Now, while we're on the subject, low unemployment can point to a strong economy, but can also predict rising inflation. Lastly, consumer spending. That is a measure of inflation. It is through the CPI, the Consumer Price Index, and it reflects changes in how much we spend, how much consumers have on a day-to-day basis to buy a basket of goods that they put together, okay? They have different baskets that they track. The core CPI takes out some of the figures that are in there, like fuel and other goods, and with respect to the general CPI. Now, inflation is what we're tracking when we look at CPI. Too much inflation means the economy is overheating, going to be bad for the indexes. Low inflation can be a potential indicator of a recession coming. Every month, economists refer to these. When these reports come out, traders trade on them, okay? The most commonly used inflation index is the CPI, as I mentioned. There's also a wholesale price index, the WPI, and the PPI, the producer price index. Now, how do we track these? My favorite site is investing.com. It's a free site. You'll go ahead and put in whatever countries you want to follow. In the U.S., here is the entire month of January. It is already in the system. You can go ahead and look ahead and see what's coming out, okay? For example, on Wednesday, January 3rd, we knew that the FOMC meetings were coming out, and certain job openings were coming out. The following day, the initial jobless claim. Coming up this week, okay, we had the PPI at the end of last week on Friday, okay? And then jobless claims Thursday. Okay, we're going to find the GDP is coming out for the fourth quarter. That's going to be a huge report. Okay, we know on Thursday, January 25th. What traders do is they will watch the release of these numbers. This is what they watch for. The previous month, the forecast by all the analysts of the current, and whether or not they came close. They beat the forecast, they didn't hit the forecast, and by how much. If it's a dramatic change, you'll see it colored, and you'll be able to place your trades accordingly. You can trade the indexes going up or going down based on the quality of the report and the economic indicator that's released. That's it, traders. Follow the reports. That'll help you in your trading, give you a heads up on what's going to happen in the day ahead.